This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Tesla sinks as Elon Musk warns of more blows to profitability, while Netflix also slumps on a disappointing revenue forecast. The yuan rally as the PBOC ramps up support with a stronger fix, with officials considering mortgage easing in China's biggest cities. And wheat prices rise further after their biggest surge in a decade. Russia makes threats against ships sailing to Ukrainian ports. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Shonali Basak is in for Kriti Gupta in New York. Shonali, so great to have you on the program. You can relax. The bank earnings are done, but we have a lot of other earnings to sort through this morning.
Absolutely, and I have the rest of the week to do that just with you. Let's take a look here, though, at the U.S. markets first, Danny, before we get into a big show. Looking into some of the negative data we're seeing here, we have S&P futures down so far on the day, as well as NASDAQ 100 futures. We're going to dip into earnings we're seeing from semiconductor makers, as well as Tesla and Netflix, dragging those futures down just a little bit here. We also have, I want to pay attention to the U.S. Yen cross, the dollar yen cross here, failing to break the 140 level. And it's an interesting moment here after a bit of strength here. We are seeing some weakness in the cross. I want to point to wheat prices as you're talking about as well, because we're seeing even more strength in wheat. There are a lot of inflationary concerns here. This is as Russia had shot a warning sign over ships in the Black Sea related to the grain prices. As you said, it was the biggest surge in a decade, and we're seeing that extension here today, Danny.
Yeah, and to be clear, it's not just wheat. We are looking at commodities rebounding today in general, not just on that Russia story, but on China's support. Shannon, you put it perfectly. It's the inflation fear that this brings. So a couple things happening in the Asia session. The strongest fix for the yuan of this year. We had some capital fund changes in terms of cross-border flow to promote that. We also had officials considering making things more easy to obtain a mortgage if you're in a big city. And then yesterday, there was also a report about them supporting private businesses. You put that all together, it adds to a commodity rally. Iron ore is what I have on my board, up 2.5%. It also meant some pretty solid strengthening in the yuan. Offshore stronger by about 0.6%. It also supported commodity currencies. I got Aussie on my board. That's stronger by 0.8%. But here's the rub. Stocks in China did not rally off of the back of this. The CSI ended the session lower. Perhaps there's some skepticism as to whether this is just a Band-Aid or something that fundamentally drives the picture. The other bad thing for stocks in the Asia trade was TSMC earnings. We're going to get into that with our reporter in just a bit. But that also translated into issues for the Europe session. Let me show you what's happening here in Europe, because technology stocks are dragging down the overall index, down nearly 2%, the worst performing sector. It's all the chip stocks. It's everything that might move on the fear that TSMC is warning their cut is going to mean bad news for Europe's chip sector, too. Meanwhile, another day of weakness for sterling after that blowout lower than expected CPI number yesterday. But two-year yields, those do creep ever so higher. But I mean, barely, Shanali. They're really holding on to that rally that we saw yesterday. But again, as we say, a lot can change today considering all of the earnings news.
Absolutely. Some rallies hitting some hiccups. We're going to talk about one of those rallies. That is Tesla, now lower in pre-market trading as the car maker warns of more hits to come to already shrinking profit margins. CEO Elon Musk saying sacrifices will help future valuations.
I think it does make sense to sacrifice margins in favor of making more vehicles, because we think in the not too distant future they will have a dramatic valuation increase. I think the Tesla fleet value increase at the point at which we can upload full self-driving and it's approved by regulators will be the single biggest step change in asset value maybe in history.
Now for more on Tesla, Bloomberg's Oliver Crook joins us now. Oliver, what do we care about when we look at the Tesla earnings today?
Hey, Shanali, this is really coming down to two things. That is market share and margin, and the war between the two. That war is being waged in price cuts for Tesla, down some 30% on some of their models from the end of last year. And, you know, we looked at, that's the only thing people really cared about looking in these numbers, the profit margin. Gross profit margin came in at 18.2%. That was a miss despite beats across the other metrics. And really, if you look back 4 or 5 quarters, that is down from something close to 30%. And Elon Musk last night said, you know what, he's willing to burn that even further. So his attitude towards the margin is, if you've got them, smoke them. The question is it working? They delivered 466,000 cars in the second quarter. That was a record. In Europe, for example, the Model Y was the single best-selling model in all of Europe. Yesterday, we got June data out. Tesla outsold Nissan, it outsold Volvo, it outsold Citroën and Fiat. These are all local players that it's beating in its own market. You know, there are some clouds on the outlook. However, though, they do have kind of demand that's there, but it's not where it used to be, and they're managing to work through it. And so you're seeing some of their inventories come up. That's 5 consecutive quarters, so that's sort of an issue for them going forward.
I mean, look, it might have been an ugly post-market session for them, Oliver, but I just pulled up the one-year chart of Tesla. Am I looking at this right, that they've rallied 130% so far this year?
Yeah, so listen, we lost what, at 1.4%, now 2.5%. That could be a big deal for some people, but who cares? If you own Tesla at the beginning of this year, you made 130%. So yeah, you know, there's a degree to which it doesn't matter that much. And there are a couple other milestones this quarter which we watch with interest. For example, Ford and GM adopting the Tesla sort of standard plug, which again, maybe not huge for sort of earnings for Tesla, but it shows how far ahead Tesla is in the e-mobility ecosystem. And Danny, the final point, the Cybertruck. There are a lot of memorable moments in Tesla history. However, the one 4 years ago where they demonstrate the shatterproof glass that shatters on impact twice will be hard to forget. And that truck was supposed to be delivered some 2 years ago. Now we got the first one rolling off the assembly line in Texas. We haven't seen them on the streets yet. But again, this is kind of Elon Musk at his best, bringing something new hardware to market that, you know, it'll be very strange to see these on the roads, probably not till the end of this year, realistically at the end of next year, but still exciting.
Also doing what he does best in creating memes. That image of the thing shattering will live on throughout internet history. Oliver, thank you so much. That's Bloomberg's Oliver Crook. And we're going to get you more analysis on Tesla's results. We'll be speaking with RBC analyst Tom Narayan later this hour. The other big earnings to sort through is Netflix. Those shares slumped in the pre-market after the streaming giant gave a disappointing revenue forecast. Despite beating expectations on subscribers, the crackdown on password sharing and a new advertising tier just aren't delivering growth the analysts expected quite yet. The Netflix CFO, Spencer Newman, tried to reassure analysts on the earnings call.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Bloomberg's Olivia Solon joins us now for more on this. Olivia, what do you make of the price action this morning? Because, I mean, they did add a significantly higher amount of subscribers than was expected.
Absolutely, yeah. They had this huge subscriber increase, 6 million compared to what analysts expected to be about 2 million in the last quarter. But you know, as you say, they've had this slower than expected ability to generate more revenue from this strategy, which has involved like cracking down on password sharing and also introducing this ad-funded tier.
Olivia, how do we expect the Hollywood strikes to affect the business?
Right, well, the Hollywood strikes, you know, it's a bit of a mixed bag for Netflix. On one hand, it's affecting some of the production of some of their hit shows, like Stranger Things. It's completely shut down. But on the other hand, it's cut production costs for the company. So they're projecting, you know, much reduced costs this year. Netflix will obviously say that they have this very deep back catalogue of movies and shows, and they also produce quite a lot of content internationally. So they think that's going to mitigate the impact of the strikes.
All right, Olivia, thank you very much for that update. That is Olivia Solon from our Bloomberg Tech team. Elsewhere in tech news, chipmaker TSMC posted a smaller than expected profit decline after the global AI development boom outweighs a persistent slump in smartphone demand. But Asia's most valuable company says the full year sales will fall by 10% in dollar terms. For more on this, let's bring in Tim Kolpan from our Bloomberg Opinion team. Tim, what is this? I thought AI was supposed to save all the chip companies. I mean, this doesn't look great for TSMC.
No, it was a real bombshell they gave us a few hours ago when they said Oh, actually, yeah, sales will drop 10% this year. Previously, they'd said low single digits, so 3 to 5%. AI is definitely giving them a boost, but even the category of AI, which is high-performance computing, is kind of soft right now. So for the whole year, smartphones are the big problem, but AI is just not enough to fill that gap. The other thing is that if we look at the numbers, TSMC's inventory has risen. The company is now sitting on $7.6 billion of inventory. Now that's chips. Chips kind of go bad, so to speak, very, very quickly because it's a very time-sensitive sector. You don't want old chips sitting on the shelves because no one will want to buy them in 6 months. That's a big problem, not just for TSMC. It's a big problem for the whole global economy because everybody uses products that they make. And if people are not buying chips, then it means that the whole economy is kind of slowing down and looking weak. Apple, for example, doesn't want to buy last year's chips. Qualcomm doesn't want to use chips from a year ago. They want the latest chips that they're designed and getting TSMC to make. So the high inventories and the worse than expected outlook for this year is weighing not just on TSMC, but on really a broader sector of the economy, of course, in Europe and in the United States.
Speaking of the United States, Tim, put into context for us what it means for TSMC to delay the output from the plant in Arizona.
Yeah, that's the other big bombshell that came today. Chairman Mark Liu told investors today that they're really facing problems getting skilled labor at that Arizona site just outside Phoenix. You need a special type of worker, someone who's got experience in handling and installing the very sensitive chip-making equipment that's going into that site. And they've been trying to get the right kind of people in the US to do it. In the end, they basically said, well, heck, we'll just have to bring our own people in from Taiwan. So they've been flying in plane loads of people from Taiwan to Arizona to live there for a temporary period of a few months to basically get that job done. But because of that, they've now pushed back by as much as a year, so back to 2025, the opening of that factory. Now, that factory was supposed to get going next year, but a delay of up to a year says a lot for the US about the skill shortage that they have there, and the fact that the US really doesn't have the skill set that they used to have in installing high detailed or sensitive semiconductor manufacturing equipment. So that's a real problem for the US. It really does reflect badly on the United States economy.
I'll tell you what, Tim, for all of the concern about PCs and mobile phone demands, it is remarkable to look at Apple hit record high after record high, this time on their development of an AI ChatGPT-like rival. How far along does it seem like they are here? Is that rally off the back of it justified, you think?
Well, I mean, I don't call stocks, but I'd say this. Basically, Apple has been out of the game when it comes to generative AI. They've been using AI for a while. Siri, for example, has AI. And they're actually quite good at AI that is used to look at photos and edit photos and search for photos on your phone. But they've stayed away from generative AI for a few reasons, one of which is privacy concerns. As we know, programs like ChatGPT, they hoover up really a lot of data. And in fact, we don't even know where that data comes from. That's part of the problem. Apple is, really big on privacy. And so what they've done, according to our exclusive reporting from Mark Gurman, is they've developed something internally, which is somewhat of an internal replication by Apple of things like Bard and ChatGPT. It's not designed at this stage to be used for consumer applications or released to the public, but it does show that they are trying to make use of these kinds of technologies, even if internally, and they're treading very, very carefully and cautiously into that realm. So the fact that investors are seeing that they are not asleep at the wheel, perhaps they are interested and they are involved, is certainly upside for the company and for the stock.
Tim, thank you very much. That's Bloomberg Opinions' Tim Kolpan in Taipei. Now, coming up on the program, the price of wheat keeps on rising after posting its biggest daily surge in a decade. We'll get more on that next. And coming up, some breaking lines over the euro area economy. Eurostat has revised their first quarter euro area GDP statistic to zero. It was at a negative 0.1%. So Europe dodges a recession in the winter. We're going to catch up with Gordon Shannon of 24 Asset Management on his take on Europe, European bonds, and the Fed. Also, coming up later in the show, we're going to talk about the next big risk. It premieres tonight. It features Boaz Weinstein and David Rubenstein. We've got a sneak peek of Shanali's conversations there.
The next time there's a serious sell-off, which is not just a 3-week affair, there are a number of aspects from the behavioral to also that the Fed is not your friend. And and in fact will not be able to come to the rescue of the market in the same way because of what's going on now.
This is Bloomberg Surveillance Early Edition. I'm Shannon Bassick in New York with Danny Berger in London. Wheat prices are extending gains onto day 3 after posting its biggest daily surge since 2012 amid escalating conflict over grain exports from the Black Sea region. For more on this, we're going to bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, when you take a look at the issue here, clearly a second day of gains here, drastic moves in wheat prices alone. How much upward pressure is there on wheat and other related commodities? Where are you looking?
People in the agriculture markets have clearly decided that this is a pretty important event. The fortunes of the grain corridor, this idea that grain could continue to flow from Ukrainian ports despite the war, that there was an UN agreement that Russia would allow that to happen. I think what we can say is that is now over, at least for the time being, and that the market realizes that Russian threats mean that it's very unlikely that any grain will be coming out of that corridor. And although its exports remain constrained, Ukraine still remains an important supplier to the global wheat market. And as the latest harvest comes in this summer, people are concerned that much less of that grain will get to market than previously thought.
Then, okay, so if prices are around $7.40 at the moment, they were something closer to $9.40 at the peak of the height when Russia first invaded Ukraine. So is it reasonable to assume we go back there? Should things be completely blocked?
Not necessarily. As I said, people are living without much less Ukrainian grain than the world was before the war, and we have strong harvests elsewhere, notably in Russia, and Russian exports continue. And of course, one of the attractions of this policy for Russia perhaps is that it boosts the price of wheat and therefore boosts the price of its own wheat, and it's good for the Russian economy. I don't think people think that we're going to retake those limits at the moment, because Ukraine right now is a relatively small slice of the global wheat market.
Okay, so does that mean then that for this to turn into a story like it did last year, where we get concerned about food inflation in general, that ability is then lessened?
Yeah, I mean, it's not comfortable. I mean, a 10% jump in the wheat price over just a few days is obviously a matter of concern, and you know, some of that pressure had come out of global food prices in recent months, and this won't help and may slow down that process. But ultimately, the wheat market is determined not just by this, but by the level of harvests around the world and the amount of supply around the world. And right now, that looks pretty healthy.
Okay, Will, thank you very much. That is Bloomberg's Will Kennedy with the latest on wheat prices and Russia. Grain coming out of the Black Sea. All right, coming up, big bank earnings wraps up. Shannon finishes what's probably her most busy 3 days ever. But she's not done. PE's up next. Blackstone's going to report before the bell. We'll have more on that next. This is Bloomberg. So with Goldman Sachs reporting yesterday, we have all of the big bulge bracket banks in the books for the earnings. Shannon, I got a question for you. How much sleep do you think you got cumulatively so far this week?
Actually, I have been clocking 8 hours a night, if you could believe it, to the extent that I was able to get to bed before 9 p.m. That is extremely
impressive, considering, I mean, like, the thing with the banking season to me, Shannon, seemed that there was just a lot underneath the surface, a lot of divergences, which I think you would have needed 8 hours for. I was listening to the Mike Mayo interview the team did yesterday. Basically, optimism that the woes are over, the liquidity, the capital, the solvency woes, that banks have turned a page. Was that your impression sorting through all these earnings?
Yeah, what's pretty incredible is that you've had Bank of America trading under book value. For what? They're increasing their net interest income. They're making money. You have a couple days in a row here that you saw such exuberance in the KBW Bank Index. Mike Mayo is telling us that he has seen the worst valuations for banks in his career in decades. And so there's a lot of question about the place of the banks, how much pain is left. We're not done yet. There's a host of regionals, there are credit card companies, Capital One today, a lot of questions about credit quality. Never ends.
Yeah, that is a really good point on regionals, seeing them really adjust their balance sheets. I mean, they have more capital requirements to deal to. We're looking for any signs of continued credit crunch. What are you expecting out of it?
Yeah, you know, it's incredible because if you think about that credit crunch in particular, there's two things going on. You have the regional banks reporting earnings, and you are seeing some pressure on net interest income. At the very, very same time, today, we have Blackstone also kicking off private asset firm earnings. We know they're making a huge push into private credit. So how much competition are these guys going to be giving not only the regional banking system, but even those big banks that are seeing underwriting come back?
I gotta say, everyone seemed just so hype, Shanali, about this idea that capital markets are coming back. Goldman was able to rally because its CFO said that it was coming back. Morgan Stanley, their big leg up was when Gorman told you that capital markets, that deal flow was coming back, that it had bottomed. I'm interested to see whether Blackstone backs up that view.
Yeah, same. And the interesting thing is, even without a flurry of deals, you've seen Blackstone just take a surge in markets this year. They're trading at a valuation right now, a market cap that is more than $10 billion more than Goldman Sachs. So that shows you what the market wants to see.
Yeah, these things are massive. I mean, Shanali, not to be controversial, if you're bigger than Goldman, do we need to have a regulatory conversation here? Do we need to have a too big to fail conversation?
Not controversial at all. I think the private equity guys will say, look at BlackRock first. They're so much bigger. Why target us? But, you know, as Don Lim at Bloomberg has reported, this could be a landmark moment for private equity, with Blackstone potentially passing $1 trillion in assets.
Well, Shanali, I'm really looking forward to your interview with the Blackstone CEO. We're going to be rolling that out later. That's, of course, Jonathan Gray, after the company reports its quarterly results. Up next, we turn back to the bond market with Gordon Shannon of 24 Asset Management. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know for today. Tesla is sinking as Elon Musk warns of more blows to profitability, while Netflix also slumps on disappointing revenue forecasts. Then the yuan rallies. The PBOC is ramping up support with a stronger fix as officials consider mortgage easing in China's biggest cities. And there's wheat prices rising further after their biggest surge in a decade as Russia makes threats against ships sailing to Ukrainian ports. I'm Shanali Basak, stepping in for Kriti Gupta in New York with Danny Berger in London. Danny, give me a look at what the European markets are doing today.
Well, it could have been a good day if it wasn't for tech, if it wasn't for TSMC, Shanali. Overall, the Europe Stock 600 is able to notch higher, but you look at the big caps, the Stoxx 50, that's not higher. They're all moving lower, and it's because of this drag of technology stocks down nearly 2% after TSMC cut its forecast going forward. It's bad news if you're ASML or kind of literally any other chip company in Europe. So that's dragging us lower. Meanwhile, the theme of weaker sterling, that continues. We're down for the 5th day in a row. Again, it has been a big move off the back of that UK CPI, but we have just rallied. We have strengthened so much this year for sterling, so we haven't yet undone that. And the 2-year yield, that's able to hold on to gains that we've seen in the gilt market. Looking at Asia, the big story was more China support. Is it incremental or is it game changing? That is the question we have to grapple with after a stronger than expected fix, after some adjustments to cross-border flow to increase investments, after some news around private companies and mortgages making that easier. So what did you see? You saw a strengthening in the offshore. That is gaining about 0.7% versus the dollar. Metals doing very well too. Iron ore up 2%. Again, optimism, maybe more home buying in cities. Aussie dollar, some jobs data in Australia that impacted that, but nonetheless, commodity currency is rallying. But again, stocks not performing, partially on TSMC, partially on some pessimism. Shanali, so is that any of that carrying over to the U.S. session if you're looking at Asia stocks falling?
Yeah, absolutely. I was going to say same here, Danny. If you take a look at S&P 100 futures, they are slightly down on the day so far. Same with NASDAQ 100. This is a little bit of TSMC here. It's also a little bit of Tesla. It's a little bit of Netflix. We'll see how the continuation of earnings season plays out, of course. These are stocks that have massive rallies. We also have the dollar Japanese yen cross. I wanted to take a look at it, Danny, because we are seeing some easing of the pressure on the cross here. We have it trading at less than 140. People are watching that marker to see if it breaks through. We are also watching wheat because it's up for a second day, more than 2%. This is after a major rally on Wednesday as well. And this all has to do with the Russian look at the Black Sea here and the restrictions being placed on wheat exports. Danny, back to you.
Yeah, Shannon, I realize this is about to be kind of an awkward pivot because you're just showing us futures that were moving on earnings. But for the most part, American equity, American risk in general has held up very well this year. Take a look at high yield spreads. I have both the high yield spreads and the global ag on here. So IG spreads, they've all been contracting. In fact, high yield spreads are the tightest since April 2022. Nothing seems able to dent that risk appetite. Does that crack at some point? Does it go further? Let's bring that question to Gordon Shannon, portfolio manager at 24 Asset Management. Gordon, what does the high yield rally do from here?
So currently the market's digesting this reevaluation that we're going to have a soft landing. And that's all based on these inflation prints. We've had the US, Europe, and even the UK give us falling inflation, which massively increases the chances that the central banks can pull off a soft landing, get inflation down without pushing us into recession. So it does open the way for a further squeezing tighter in credit spreads. What I'd seen so far this year is large inflows into investment grade, because when you've got an uncertain macroeconomic backdrop, you want quality. Now I'm starting to see clients want more duration, ultimately more gilt exposure. But I think that there's plenty of room here for people to push further into high yield because they've just got that bit more certainty.
I know this is difficult to answer since we're only just at the beginning of earnings season, but do the fundamentals back it up versus just interest rate risk?
Yeah, no, not necessarily. We've seen most of the Q3 earnings be down, but yet the equity market's held up very well, leaving today aside. So valuations are becoming more stretched, but I just don't see any appetite right now for people to properly assess downside risks.
Speaking of downside risk, Gordon, I mean, how much exactly is there in terms of your expectations for any loss of capital for all the people who have poured into high yield thinking it is sanguine enough to do so?
I think the expectation is, even if we have a softish landing, that default rates are going to stay low. So as long as you stay away from the lower quality end of high yield, the triple Cs, the scope for capital gains and to avoid defaults is high.
Well, speaking of taking on a little bit of risk here, I mean, how far down the spectrum should people really go? I mean, is there a sense here that high yield maybe gives you better protection than, say, the leveraged loan market, which is trying to make its way back?
I mean, what I think is particularly interesting here are callable bonds, bonds with extension risk if they aren't called, because as we've got more clarity that yields are going to come down, the expectation that those bonds will be called goes higher. We don't have to worry about them staying outstanding to perpetuity. So here I'm talking about bank AT1s or corporate hybrids. So those have beta just like high yield. But at this point, there's potential not just for strong levels of carry, but also for capital gains as those bonds are taken out.
So the sovereign bond market, this rally has just been fueled by UK yesterday, basically all the data we're getting. What are the odds that the BOJ announces something like a tweak of YCC and completely upends this whole thing?
You have to keep open to these things. They're trying to balance a number of different features. I think what central banks everywhere are worried about is that the labour markets are still tight.
Right. But wait, just on that point of the BOJ, if they do tweak YCC, does that upend the rally? Do we need to reconsider the ability for bonds in Europe, UK, US to keep going?
I think the market will find a way to look through that.
So it doesn't care, it keeps rallying?
Yeah, I think so, yeah.
Huh.
I mean, the other thing about this, too, that I've been wondering is how much risk is there to just inflationary shocks in particular? I mean, we're talking about this cross-current in commodity prices right now with the re-escalation here on the attack on trade, on wheat. But how much could those types of ripple effects really ruin the trajectory that we're on?
I think the base effects are so high that regardless, you're going to continue to see a fall in headline inflation. But what the central banks are most interested in is core inflation, and in particular, core services. That's generally what they look at as their proxy for domestically generated inflation. So, while commodity prices going up, eventually those do become an issue, and and I think they feed into a wider geopolitical problem. It's probably less of an issue for the next couple of prints, and something that the central banks won't be paying as much attention to.
If I can just jump in here, because, as you say, we're going to keep rallying. The narrative seems to be one more, we're finished. Soft landing. Even Marko Kolanovic is saying there's going to be a soft landing, which I think means something. I just can't help but wonder, Gordon, are we reading too much into it? Are we too optimistic? I mean, we've only had a few data prints at this point.
Well, that's it. One data print isn't a trend. And as we've talked about before, I'm a big believer in the yield curve, and the inversion of the yield curve tells us a recession's coming. Now, if we compare previous periods when we've had the inversion of the yield curve and then how long until the recession happens, sure, we versus previous ones, we're slightly overdue. But if you compare us to, say, the February 1980, the Volcker-inspired recession there, that would put us at timing of us entering the recession round about December. So, the fact that 2s, 10s are still minus 90, that's a red flag.
Right.
I'm really curious here about whether this idea that inflation easing is enough of a story. I mean, the bank, companies still have to make enough money to repay the interest at a higher rate too. So, are there other risks tied to corporate profitability here when we're thinking about the riskier bond markets?
Well, I think that the conundrum for the market has been just how well consumer sentiment has held up. So everyone has worried about, and I'm still worried about, the cumulative impact of monetary policy tightening and when that cuts into consumer spending. But consumers, certainly in the US, have been willing to run down their savings. And thus, there's been money for companies that need it, the cash flows they need to keep paying their coupons. And there was a huge amount of refi done in 21 and 22 at relatively low costs of debt. So the maturity wall doesn't hit us for another couple of years. So there's, certainly in short-dated debt, there's a certain level of comfort that can be taken there.
And then again, this comes back to the idea of triple Cs. Those spreads have held up. What do you want to do to prepare yourself in case this doesn't come to fruition? Because, Gordon, it does feel like this is the overarching narrative for most people. If the crowd turns, where do you want to hide out?
Yeah, you want to make sure you're in businesses that can be resilient through a recession. You want to have a portfolio that's nimble, that you can change around, because there are a number of variables here. So keep it more resilient. To me, that means keep it higher quality.
All right, Gordon, thank you so much for joining. That's Gordon Shannon, 24 Asset Management Portfolio Manager. Now, coming up, Tesla extends declines with Elon Musk warning of more blows to margins. We're going to have more on that with Tom Narayan, lead equity analyst for global autos at RBC next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sonali Basak is in New York. Let's turn to Tesla. The electric car maker is trading lower in the pre-market session. The company warned of more profit hits to come, more spending. Joining us now is Tom Narayan, Global Autos lead equity analyst at RBC Capital Markets. Tom, what do you make of the price action? Was what you heard yesterday, does that sound like something that should send the shares lower?
Yeah, I mean, it's down about 2% now after hours. I think it was down more before that. I get it. I mean, the actual earnings itself was pretty good. It was a beat on gross margins. Came in at 18.2%, above consensus. But then on the earnings call, I think there were some comments from the CEO, from Mr. Musk, about spending on autonomy and software, which I think may have shrugged some investors. A lot of them are retail investors who want kind of a quick payoff immediately. And also there's some other things, more R&D spending. But the reality is, as everybody knows, if you're buying Tesla stock, you're in it because of the future and on autonomy, which is FSD, which is robo-taxis. And in order for those to work, you're going to have to spend today. But I do remind folks, if you compare Tesla to any other automaker, it still posted 10% operating income margins, and it's selling 100% electric cars. There's no other automaker that's doing these types of numbers. I think people just get caught up because the stock has run a lot into the print. But really, all in all, if you look at the big picture, I actually think this is a pretty good quarter.
Okay, fine. Pretty good quarter, but to the point you're making, the run-up in the stock has been 136% this year alone. Does it just need some cooling off here, given some of the near-term pressures they say on production?
That could be what's happening, right? I don't think anybody was expecting a 3Q cut in production. Everyone thought that they would blow out the 1.8 million units this year and hit like a 2 million number. So maybe that's not happening now. So it could be some of that. But ultimately, if you're going to own a stock like this, that's a $1 trillion market cap potential, you have to believe in FSD and robotaxis. The math just doesn't make sense otherwise. And they believe they need to spend to get there. And there's not that many other companies outside of Tesla that has the cash to spend on these things. So it's a little bit nebulous now. What is a supercomputer? What exactly does that mean? There's a lot of open questions to be answered. But this is a company that has a track record of proving itself out over time.
But Tom,
and ultimately, we think that's probably
even if you believe in the long term of Tesla, I think it's worth digging into here, especially because we're starting on a down day after a good day of earnings, on what the challenges are on the way there.
Yeah, sure. There's a lot of challenges, right? So FSD is it's a level 2+ system that's only maybe 5% of Tesla cars have them today. Not that many people know about its quality, but if they lower the price from the $200 a month to, let's say, $50 a month, the take rate explodes and people will be better aware of it. And then robotaxi is like 10, maybe 15 years away. So it's a prove me concept. There's no doubt about it. But you remember, with this stock, it's kind of like Amazon was 15 years ago. There's enough people that believe in the future. That thesis is always there in people's eyes. That I think that does create support for the stock, especially with the AI investment craze right now. That's not really going away. So as long as that's around and that bubble, let's say, doesn't burst, if it is one, I think you're going to still see support for Tesla shares.
So if we should be patient for Tesla as it's a future story, how patient, Tom? When does the rubber hit the road? When do we finally see margins that keep up with the price action?
Oh, you're not going to see margins keep up with price action for some time, right? But the point is that, a car margin is like 10% EBIT margin. A software margin is like 80 to 90%. Now, you're not going to see that impact numbers probably for years, right? They're not going to get, the numbers of cars on the road with their software for a while. But, they did announce on the earnings call that they're in discussions with a major OEM to license their FSD software. That is very telling, because if you run the math on licensing software to other OEMs, you can come up with some big numbers. So margins probably pressured near term. They can sacrifice margins in order to get more volume on the road. But this company doesn't see themselves as a car company. They see themselves as a software company. So investors will have to probably be patient, but they could be happy with announcements like, hey, we're launching a robotaxi service in this city, and FSD take rate has expanded from 5% to 30%. And these sorts of headlines will, I think, help investors get more comfortable with the long-term investment thesis.
That's RBC's Tom Narayan. Thank you so much for your time. It's a busy day for Tesla investors for sure. Now let's get a quick check on the stocks moving in pre-market trading. We are taking a look at Tesla here. It is down more than 3% now on the day, heading into U.S. trading. We also have Netflix as well, down more than 6.6% on the day. TSMC shares down more than 2%, almost 3%. But we do have American Airlines Group. That is a sign of positivity there, up more than 2% on the day. It is part of what is leading, I believe, the Dow a little higher in futures trading relative to the S&P and the NASDAQ 100. Tough day for tech, Danny.
But you gave us one good story, Shanali, and that we will take, although I don't think American Air has even reported earnings yet, have they? So hopefully the good news can continue for them. All right, coming up, the latest episode of The Next Big Risk premieres tomorrow night, featuring Boaz Weinstein and David Rubenstein. We've got a sneak peek next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Shannon Bassick in New York with Danny Berger over in London. Now, investing involves the business of managing risks, and the past year has served up no shortage of warning signs. I asked Boaz Weinstein, Ida Liu, and David Rubenstein what they think the next risk is for markets. Here's what Rubenstein had to say.
The biggest concern overall is a clash between the haves and the have-nots. In the Western world, the clash is going to be between the older people and the younger people. The older people are living longer and longer, but the retirement benefits are not really going to keep up with what they expect or what they need. And the younger people are going to have to say, we don't want to work that much harder just so you have a better retirement. So you're going to have Social Security in the United States, for example, not being adequately funded. You're going to have other endowment programs that aren't adequately funded. And the result is going to be more and more people are going to be fighting between a clash of age groups, you could say, the haves who are working hard and want to make more money for themselves, and the have-nots who want more money to be given to them for the retirement purposes that they need. In the emerging markets, it's going to be between the haves and the have-nots in the sense that the haves who've run the world for the last 50 to 75 years, the Western world, Western Europe, United States, and so forth, they have the wealth and they have the means to really live lives the way they largely want. The have-not nations, the emerging markets, are going to basically say, well, we want some of the wealth of the world. We want more influence in the world. We want to control some of the bodies like the UN and the bodies like the World Bank, and we haven't had that kind of influence before. So increasingly, you're going to see in the Western world, the retirees clashing with the younger people, and in the old world as a whole, you're going to see the people that have had the power for the last 50 to 70 years fighting with the people who haven't had the power who now want it. And that's how I think the biggest fights you're going to see.
The latest episode of The Next Big Risk premieres tomorrow at 8:30 p.m. New York time. Danny, you could actually find the story right now on the Bloomberg terminal as well. One of the most interesting things David had to say to me as well is this idea that inequality can only keep rising for a lot of structural reasons. One of them being that if you're here in the United States, I know we're done with the debt ceiling conversation for the summer, but one of the problems is he was saying just how much the debt load has risen, the U.S. debt load since he was in Washington himself and serving the White House. And the only idea here is you can only inflate your way out of it.
Yeah, Shannon, I've got the story up right in front of me now. As you said, it's out. I have to say, and we heard it there, one of the more depressing things he said about that topic exactly is that everyone's paying lip service to it. Everyone knows there's an issue, but what are people doing about it? Politicians recognize it, government officials around the world recognize, but I don't think they're able to do much about it. Shannon, I know the title is The Next Big Risk, so we're talking about grim things here anyway, but this is a risk that feels like no one has the appetite to solve.
Yeah, and that's why I think some of these risks are brought up in this vein. I asked 5 to 10 years, longer time horizons here, because really we talk about market, daily action trading, but the reality is if you're investing, many of these investors are trying to invest over longer term horizons, particularly at David Rubenstein, where you're thinking about private equity. But another interesting one was Boaz Weinstein, kind of really worried about even liquid market challenges with the Fed tightening, right? He's kind of really pointing out here that even market risks are not being accounted for with where we are in the cycle.
Yeah, that one I really liked, Shannon, probably just because, I think about kind of the macro all the time, but this idea that, sorry, folks, the Fed is not going to come save you this time. If we get another sell-off like we did in 2020, the Fed ain't going to step in. They're doing QE now. They're doing QT now, rather, not QE. Shannon, for me, that was pretty jarring.
And you know what? People forget about this about you and me, that you and I reported on the quants. So we pay attention to those nerdy little nuances when it comes to tail risk and the people who are watching it.
Exactly. Shannon, always remind the people of the quants. We can never forget them. Shannon, really great to have you on the show today. We'll do it again tomorrow. That's it for Early Edition. Surveillance is up ahead. Deutsche Bank chief economist will be joining the team there. This is Bloomberg.